Okay, here is the absolute bottom line for today's explainer. The market literally just hit an all-time high. But listen, if you're seeing those headlines and thinking about ripping off your portfolio hedges right now, well, that is a classic amateur move. Plus, the entire battleground for AI stocks has completely shifted right under our noses. So let's dive into the actual structural reality of this market and look at exactly how professional portfolio managers are playing it. The S&P 500 just shot up almost 1.5%, and the Nasdaq, it surged over 2% to hit some truly staggering all-time highs. Now, retail investors are totally caught up in the euphoria, celebrating all that green. But professional fund managers, we're looking at a completely different landscape. Pros view these surface-level numbers with some pretty deep skepticism, mainly because they see underlying structural fragilities that flashy headlines just completely ignore. Which brings us to our golden rule for today. Do not chase with emotion, confirm with structure. It's really that simple. Amateurs buy the headline. Professionals, on the other hand, wait for the underlying structural changes in the market to actually prove themselves. Frankly, it's the fundamental difference between gambling and real investing. All right, Section 1, the two engines driving the surge. So, this record-breaking rally wasn't just some random fluke. It was ignited by two completely independent yet incredibly powerful forces firing at the exact same time. First up, geopolitics. We saw this massive wave of hope for a 14-point, one-page MOU peace framework between the US and Iran, which is really aiming to cool down global tensions. And second, technology. AMD absolutely crushed their Q1 earnings, and that provided some undeniable validation that this AI boom isn't just alive, it's accelerating. Now, that geopolitical engine caused WTI crude oil to completely plummet, dropping almost 6% down to around $96. Your immediate instinct here might be to shout, oil is dropping, ditch the energy shorts. And hey, that's a completely natural reaction. But absolutely do not sell your energy hedges yet. Dropping them right now is a massive trap. And I'll break down the exact logical structure of why we must hold the line in just a second. But first, let's talk about that second engine. On the tech side of things, AMD's data center revenue totally exploded with a 57% year-over-year growth. That metric alone basically validated the entire tech sector. It wasn't just an isolated win for AMD either. It acted like a massive secondary thruster that pushed the broader market to the moon, confirming that corporate spending on high-end tech infrastructure is still incredibly resilient. Moving into Section 2, the professional's playbook, holding the line. Okay, so here is that counterintuitive professional strategy I mentioned a minute ago. You absolutely must maintain your XLE energy hedge, even with oil prices taking a nosedive. Why? Because there is a massive, massive difference between a ceasefire headline, which the media obviously loves to pump, and actual market normalization. Just because there's a headline doesn't mean the underlying risk to the global supply chain has magically vanished. To safely drop that XLE hedge, we really need to clear some strict structural hurdles. Getting an MOU agreement, that is literally just step one. After that comes the actual lifting of nuclear sanctions. But the most important thing, and this is absolutely crucial, over 40 countries must physically confirm safe, free passage in the Strait of Hormuz. We need real-world, global supply chain verification. Until that final step is verified in reality, not just in theory, the hedge stays put. Because here is the reality check. Even after that big headline drop, WTI crude sitting at $96 is still structurally elevated way above its pre-war levels. Throwing away your portfolio insurance based on pure optimism when oil is still sitting that high, that's an incredibly expensive risk to take. Think about it. You wouldn't cancel your fire insurance just because it rained once, right? All right, Section 3, the AI hardware shift. CPUs join the fight. Let's shift gears to the second huge structural insight from today's data. Listen closely to what AMD's CEO, Lisa Su, explicitly stated. She said demand is increasing for accelerators and CPU server chips. Guys, this is a huge revelation. The whole AI game is no longer just about hoarding GPUs. The entire hardware battleground of AI infrastructure is rapidly evolving. So why the sudden shift? It is all about AI inference models. We are finally moving past that initial training phase, where you just dump oceans of data into a system, and we're entering in the inference phase. This is where AI actually applies its training to solve real-world problems. Think of training like going to school and inference like actually doing the job. And this inference phase requires a highly distributed mix of processing. You absolutely need massive CPU power seamlessly paired with those GPUs to make these models work efficiently in the wild. And this shift in demand is creating giant ripple effects across the whole market. It totally validates the sustained $500 billion, yes, trillion with a T, in hyperscaler CapEx we've been tracking. It also gives a huge boost to the canary group of mid-cap tech stocks that support all this infrastructure. And crucially, it justifies these massive independent projects, like the incredibly ambitious Tesla and SpaceX Terafab plan. The sheer scope of this infrastructure build-out is just getting broader by the minute. Now for Section 4, the valuation warning signs. So, peeling back the layers of these all-time highs, professionals are carefully watching for risks because the market is severely bifurcated right now. On one hand, you have clear winners like Novo Nordisk absolutely dominating with their oral GLP-1 win. But then, you have glaring warning signs like PayPal. I mean, they completely beat their earnings, but the stock still tanked on regulatory fears. It is the classic beat and drop, which is a glaring signal that the market is severely punishing any perceived risk right now. And you know what the absolute biggest warning sign is that the pros are watching? The US 30-year Treasury yield. It is sitting dangerously close to 5%, specifically at 4.939%. A long-term yield creeping up that high acts like structural gravity. It puts intense, undeniable downward pressure on high-valuation satellite stocks like Palantir or ServiceNow, simply because it heavily discounts the value of their future cash flows. Which brings us to our final part, Section 5, Actionable Portfolio Strategy. So, how do we actually put all of this into action? Well, the VIX has dropped down to 17.39. Technically, that clears our Rule of 20 barrier, which points to a potential entry point for new risk assets. But, and this is a big but, pros do not jump on a single one-day print. No way. We demand multi-day stability. We need to see that fear gauge stay consistently low before we even think about committing new capital. So here is the strict, rule-based playbook. For your core positions, things like the S&P 500 or Berkshire Hathaway, just continue your blind dollar-cost averaging. Tune out the noise. For your hedges, specifically XLE, hold it fiercely until that 40-country Hormuz clearance is 100% verified. And for those high-valuation satellite stocks we talked about, just sit on your hands. Wait for a clear downward direction in that 30-year yield before you start buying. So, I'll leave you with this final thought. Is your portfolio moving based on emotional news headlines, or is it grounded in verified market structure? It's time to stop trading like an amateur. Stick to the rules, trust the structure, and I'll see you in the next explainer.